Planning on investing in the stock market, one of the most basic things you should know is what type of business you're going to own. If a company is on the stock market, it's a public limited company. But what does that mean? And what are the other types of business? We'll take an insight into sole traders, partnerships, private limited companies, and public limited companies to give you a sound understanding of what they are and what it means for the owners. In this video, we're going to focus on the private limited company. A private limited company, or LTD, is a type of privately held small business entity in which owner liability is limited to their investment in the company, the firm is limited to having 50 or fewer shareholders, and shares are prohibited from being publicly traded. A company becomes an independent legal structure when it incorporates and gains the LTD banner. Examples include some people's favorite chocolate, the Mars Corporation, and one of the big four accounting firms, Ernst & Young. These are two very different companies that share the following characteristics. The membership of a private limited company must include at least 2 shareholders, but not more than 50 in the UK. Each share is equal in terms of cash flow rights and ownership rights. There must also be at least 1 director. It's important to note that these figures are correct for the UK, but each country will have its own laws for the number of shareholders and directors. Unlike a sole trader or general partnership, a private limited company has limited liability. This means that the business is a separate legal entity to the business owners. If the business is sued or owes money, then it is only the business that is liable, and the owners are not at risk of losing their personal assets. The owner can lose only what they put into the business, and their share value could drop to 0 if the business goes bankrupt. In an unfortunate scenario where one of the owners dies, goes insolvent, or bankrupt, then the business will continue its operations as normal. As the business is a separate legal entity, it is not concerned with what happens to the owner. If something happens to any shareholder, the shares are reallocated as per that person's will. A business must be legally registered with the authorities to be recognised as a separate legal entity, with the registrar in the UK being Companies House. A business, one registered with the authorities, must produce certain accounting reports and file them with the registrar. So in the UK, such accounting reports would have to be registered with Company House. Unlike a public company, however, the private company does not need to publicly disclose this information. A private company can receive funding from bank loans, private equity funds, angel investors, and the owner's friends and family. However, they cannot go out to capital markets and receive debt or equity funding. Now we've covered the key characteristics, let's look at the advantages and disadvantages. Limited liability means the business is a separate legal entity, which protects the owners from legal fault. Owners can use the business to create more tax-efficient income, where they can make themselves a salary and top this up with dividends after paying corporation tax. The incorporated business can legally protect their name, as others cannot trade under the same or a similar name. The business can raise capital more easily by selling additional shares of the business through private means. Finally, the business is more likely to do business with other companies, where large corporations are more inclined to do business with only other large businesses. Moving on to the disadvantages, let's take them in turn. The business now has certain legal requirements to fulfill, such as annual accounts, corporation tax returns, setting up a payroll, and producing VAT, value-added tax, returns. If the business misses any deadlines, they'll have hefty fines to pay. Unlike a sole trader, the owners cannot readily and easily take cash out of the business to supplement their personal income. They have to pay salaries and dividends to transfer cash, which must be taxed. The setting up and closure of the business is a little more lengthy, although quite straightforward. Setting up requires registration with Companies House and informing HMRC, Her Majesty's Revenue and Customs. On the other hand, closing the business can take 3 months, as to dissolve the business is complex and costly. Finally, funding cannot be secured through public means. Although the business can sell extra shares for funding, they cannot go to capital markets, which means that funding is restricted at some level.